When you break your arm, the X-ray is entirely binary.
Right.
It is either broken or it's not.
Right, it's very clear.
Yeah, exactly. You look at that stark black film, you find the jagged white line, and the diagnostic reality of the situation is just undeniable.
Unmistakable.
And we naturally crave that kind of visible, categorized certainty, especially when evaluating where to park our investment capital.
Oh, absolutely. Investors hate ambiguity.
Right. But looking at Eversource Energy's Q1 2026 earnings, well, it is like staring into a shattered X-ray machine.
Yeah, that is a very accurate way to put it.
Because on the surface, the physical reality is incredibly visible. You have this historic 40-inch blizzard, a massive grid recovery effort across the Northeast, and the tangible, heroism of line crews working around the clock.
Which is great PR, obviously.
Right. But underneath that visible triumph, the financial S-ray is completely clouded by a sudden retroactive regulatory smackdown from the federal government, plus the delayed sale of a major water subsidiary.
And a CEO who is actively and publicly turning away the biggest tech revenue cash cow of the decade.
Yeah, the AI data centers, which we will definitely get to. So welcome to a special Talk Tickers edition of this deep dive.
Excited to be here.
Our focus today is breaking down Eversource Energy, ticker symbol ES. Our mission is stripping away the corporate messaging to give you the raw data, the underlying operational story, and an actionable verdict on this stock.
Getting right to the point.
Exactly. So the question we're unraveling for you today is pretty complex. How does a major Northeast utility navigate unprecedented physical weather extremes and an equally hostile federal regulatory environment, all while engineering a capital plan designed to protect your shares from dilution?
I mean, operationally triumphant but structurally noisy is really the only way to accurately frame this quarter for Eversource.
Structurally noisy, I like that.
Yeah, because to grasp the current valuation of ES, you have to look past the surface level disaster recovery. You have to dig into the legal and regulatory boardroom battles that are just playing out in the background right now.
Yeah. Because the core business is actually doing well.
Right, exactly. The core business is humming along nicely. But the financial metrics, well, they have been violently distorted by decisions made in Washington, D.C.
Based on some really old data, too, if I remember correctly.
Yeah, based on economic data from over a decade ago. It basically forces investors to play a game of forensic accounting just to understand the company's true baseline profitability.
Right, which is exhausting for the retail investor. So let's jump straight into that forensic accounting. Let's start with the headline numbers.
Sounds good.
So Eversource reported Q1 2026 GAAP earnings of $1.61 per share.
Which is up, right?
Yeah, that is a noticeable jump from the $1.50 they reported in Q1 of 2025. But management immediately directed Wall Street's attention away from that GAAP number.
Of course they did.
Right, they pointed toward their non-GAAP earnings, which came in significantly higher at $1.73 per share.
Right, that 12-cent gap.
Yeah, and that 12-cent differential, it isn't some vague amortization of goodwill or a minor restructuring tweak. It is tied to a brutal, very specific one-time hit.
It's tied exclusively to a $43.9 million after-tax charge. And the mechanism behind that charge is crucial for you to understand.
Why is that?
Because it highlights the unique vulnerability of regulated utilities. So on March 19th, the Federal Energy Regulatory Commission, FERC...
The federal body overseeing interstate electricity transmission.
Exactly. FERC issued a decision requiring Eversource to issue a 15-month retroactive refund to its customers.
Wait, retroactive, like going backward?
Yes. The company had to suddenly take nearly $44 million that it had already earned, already accounted for, and wipe it off the books to refund ratepayers.
Wow. Just erased from the ledger.
Gone. And that $44 million, it translates flawlessly to the 12-cent gap between the $1.61 gap and the $1.73 non-GAAP earnings.
Okay, so Wall Street strips that 12-cent penalty out because it's a retroactive one-time artifact? It's not a reflection of how the utility is operating today.
Precisely. You have to look at the run rate of the actual business.
And when you look at that $1.73 non-GAAP figure, the underlying engine actually looks remarkably strong. I mean, management stated the quarter was entirely, quote, in line with expectations.
Yeah, which is an incredible statement given what happened.
Right, because that non-GAAP number represents a 23-cent year-over-year improvement compared to Q1 2025.
And delivering a 23-cent improvement in a heavily regulated, capital-intensive core business, while simultaneously taking a $34 million federal punch to the jaw, I mean, that requires some serious operational momentum.
It really does.
So where did that momentum come from?
Well, we have to isolate where those 23 cents of improvement actually materialized. Because utility revenue growth is never accidental, right? It is negotiated.
It's a rate cases.
Exactly. The bulk of that growth, an 18-cent per share boost, came directly from newly secured rate-based increases.
So state-level approvals. Yeah, Eversource successfully navigated the regulatory gauntlet to implement higher base rates in Massachusetts. And they also folded in the newly approved Yankee gas rate case down in Connecticut.
Okay, so that's 18 cents.
Right. And then you pair that 18-cent foundational boost with an additional 6-cent per share bump generated by their ongoing investments into the electric transmission grid.
Okay, so they secured 24 cents of positive momentum on the revenue side by just getting state regulators to acknowledge the rising costs of maintaining the grid and passing those costs through to the base rate.
Yep, the regulators agreed the costs were justified.
But obviously, 24 cents of gross momentum doesn't equal a 23-cent net improvement, so there have to be offsets.
There always are.
Think of this dynamic like getting a long overdue promotion at your corporate job. You finally negotiate a substantial raise, so your gross paycheck looks fantastic.
That's your 18-cent rate base increase.
Exactly. But simultaneously, your local municipality hikes your property taxes, and the variable interest rate on your mortgage resets higher. Your gross income is up, but the macroeconomic environment just made your fixed carrying costs noticeably heavier.
That is a perfect analogy. For Eversource, that heavier carrying cost manifested as a 5-cent per share hit at the parent company level.
And what drove that 5-cent hit specifically?
It was driven entirely by a higher effective tax rate and elevated interest expenses. I mean, the macroeconomic reality of 2026 is just inescapable for utilities.
Because they had to borrow so much money.
Right. They don't fund billion-dollar grid upgrades out of petty cash. They issue massive amounts of debt.
Right.
And when the cost of borrowing capital rises, that interest expense eats directly into the per-share earnings margin. It neatly offsets some of those hard-fought rate case victories.
Yeah, it's just the cost of doing business right now.
Yeah.
So the rate cases and the interest expenses are the predictable spreadsheet side of the utility business.
The boring stuff. Yeah.
Right. But the physical reality of Q1 2026 was defined by the unpredictable. We really have to dissect the February blizzard, not just as a weather event, but as a massive financial stress test.
It was an absolute monster of a storm.
It was. I mean, this storm dumped over 40 inches of snow across the Northeast. It hammered Massachusetts specifically, with wind gusts tearing through at over 70 miles per hour.
Yeah, the grid took a massive beating.
The operational metrics the CEO, Joe Nolan, cited were staggering. Over 2,000 fire, police, and safety emergencies responded to. More than 500,000 individual customers losing power.
And restoring 500,000 outages in the wake of a 40-inch snowfall is a logistical mammoth.
How do they even coordinate that?
Well, Eversource mobilized thousands of line crews. They activated interstate mutual aid networks to bring in outside contractors, and they deployed advanced remote switching technology to route power around downed physical infrastructure.
So they were rerouting power digitally while fixing the physical lines.
Exactly. And by all conventional metrics, the response was highly effective. I mean, customer surveys showed strong approval for the speed of restoration.
That's rare for a utility after a massive outage.
It is. But restoring power at that velocity is unbelievably expensive.
I can imagine.
You are paying premium overtime. You're housing and feeding out-of-state crews. You're rush ordering heavy materials. The upfront capital required to fund that kind of emergency response creates a massive immediate crater in the utility's short-term cash flow.
So how do they normally handle that cash crater? Historically, the financial mechanism for dealing with that is pretty painful for the utility.
Oh, it's terrible. They essentially have to front the money. They put the entire cost of the storm renovation on what amounts to a high-interest corporate credit card.
Yikes.
Yeah, and they log it on their balance sheet as a, quote, deferred regulatory asset. And then they spend the next 5 to 10 years begging state utility commissions for permission to slowly, incrementally add those costs to customer bills.
That sounds incredibly inefficient. It just traps capital and severely degrades their cash generation metrics.
It does, and that historical pain point is exactly why the most critical development out of this quarter isn't the storm itself. It's a financial rescue mechanism that was triggered in its wake.
Okay, tell me about this rescue mechanism.
We are seeing a complete paradigm shift in how states handle these extreme weather events. Both Connecticut and New Hampshire have formally authorized the use of storm cost securitization.
Securitization.
Yes, and this is a profound catalyst for Eversource's balance sheet.
let's break down the actual mechanics of securitization for the listener, because, on the surface, it sounds like Wall Street alchemy.
It kind of is, but in a good way.
Right, but how does a state authorizing securitization actually solve the utility's immediate cash crater without simultaneously enraging the ratepayers who ultimately have to foot the bill?
Well, the mechanism is actually elegant in its efficiency. Instead of Eversource holding that deferred storm debt on its own balance sheet and slowly recouping it, the state legislature allows the creation of a special purpose entity.
An SPE.
Right, an SPE. Eversource then sells the rights to future ratepayer storm surcharges to this entity.
Okay, so they pass off the right to collect the money.
Exactly. That entity then issues highly rated bonds to institutional investors, and those bonds are collateralized by the guaranteed future payments from the ratepayers.
Because the state basically stamps it and says, yes, we guarantee these citizens will pay the surcharge.
Yes, because the state guarantees the bond through legislation, the risk profile is virtually zero, meaning the bond carries a very low interest rate.
And Eversource gets paid right away.
Bingo. Eversource gets a massive, immediate lump sum cash payment from the bond sale to instantly replenish its corporate bank accounts.
Okay, but I have to challenge the premise that this is a flawless win-win. Isn't securitization fundamentally a shell game?
How do you mean?
Well, the utility gets its cash instantly, sure. But you're still forcing the residential ratepayer to pay off a bond over the next 10 years. In an era where basic energy affordability is already a massive political flashpoint, doesn't adding a dedicated 10-year bond fee to monthly utility bills invite the exact kind of regulatory pitchforks that management is desperate to avoid?
It absolutely carries political risk. There's no getting around that. But you have to compare it to the alternative.
Which is the traditional deferred accounting.
Right. If the utility used the traditional method of recouping costs, they would be charging the ratepayer based on the utility's own weighted average cost of capital.
Which includes a profit margin for their equity investors, right?
Exactly. It includes an equity return component, and it is significantly more expensive. Securitized bonds strip out that equity return completely. They leverage the state's legislative guarantee to secure institutional debt at rock-bottom interest rates.
Oh, I see. So the interest rate the customer pays on the securitized bond is much lower than the return Eversource would demand if they held the debt themselves.
Yes. The total long-term mathematical cost passed on to the grandmother paying her heating bill is demonstrably lower through securitization.
It makes a lot of sense.
It mitigates the affordability crisis while simultaneously solving the utility's liquidity crisis.
And the scale of the liquidity being unlocked here is just staggering. The CFO, John Morera, confirmed that between the Connecticut and New Hampshire dockets, this securitization process is engineered to inject roughly $2 billion in hard cash directly into Eversource over the next 12 to 18 months.
$2 billion is a massive needle mover.
Huge. New Hampshire alone accounts for roughly $470 million of that, which notably includes the carrying costs like the interest that Eversource has been bleeding while waiting for recovery.
Right, because they've been fronting the money this whole time.
Exactly. Injecting $2 billion directly onto the balance sheet radically repairs their FFO to debt metrics, the ratio of funds from operations compared to total debt. And that is the exact metric credit rating agencies just obsess over.
It really fortifies the balance sheet at the exact moment they need it most. Which, pivots us back to the most complex, frustrating element of this earnings call.
The FERC drummer.
Yeah, because if Eversource is operationally succeeding, navigating rate cases smoothly, and about to receive a $2 billion liquidity injection, their future guidance should be aggressively bullish.
Right, they should be raising guidance.
But instead, management was forced to slash their future earnings outlook, entirely due to the invisible regulatory war happening at FERC.
We mentioned the $44 million retroactive refund earlier, but we really need to explain the structural cause of that penalty. Because the Federal Energy Regulatory Commission dropped an absolute bomb on New England transmission owners on March 19th.
A total surprise attack.
Yeah, regarding their base transmission return on equity, or ROE. The ROE is essentially the guaranteed federally approved profit margin that a utility is allowed to earn on the high voltage transmission lines they build and maintain across state borders.
And for context, Eversource and its regional peers have been operating under a base transmission ROE of 10.57% for over a decade.
10.57%. That's a solid guaranteed return.
It is. But that 10.57% figure was established way back in 2014, and the legal history surrounding that specific number is just a labyrinth of bureaucratic dysfunction.
How far back does this go?
The original formal complaint challenging the fairness of New England transmission rates was actually filed on October 1st, 2011.
2011?
Yes, over a decade ago. Since that initial filing, the issue has bounced endlessly through the federal system. The U.S. Court of Appeals even stepped in during 2017 to vacate FERC's previous orders on the matter. It created this massive vacuum of legal uncertainty.
The timeline is legitimately absurd. We are talking about a single rate dispute that has spanned 5 separate presidential administrations.
It's insane.
Throughout the life cycle of this single piece of litigation, FERC has cycled through 22 different commissioners and 13 different chairs. It is the definition of a regulatory purgatory.
Pure purgatory.
And then, out of nowhere, on March 19th of this year, this current iteration of FRC abruptly issues a mandate arbitrarily cutting that guaranteed base return from 10.57% down to 9.57%. A brutal, flat, 100 basis point decapitation of their transmission profitability.
And the 100 basis point cut is painful, obviously. But the methodology FERC utilized to justify the cut is what had Eversource management visibly furious on the earnings call.
What did they do?
To establish the new 9.57% rate, FERC relied on market and economic data pulled from the early 2010s.
Wait. They use 10-year-old data to set rates for today?
Exactly. They used the low inflation, low interest rate macroeconomic environment of 2014 to dictate the acceptable return on capital for infrastructure projects being built in the high inflation, high interest rate reality of 2026.
That is just mathematically indefensible.
Management openly characterized the methodology as, quote, arbitrary and capricious, which is specific legal phrasing signaling their absolute intent to litigate.
Oh yeah, arbitrary and capricious is fighting words in administrative law. And Eversource isn't just releasing angry press statements. They are actively weaponizing the regulatory framework to fight back.
They are not taking this lying down.
No. They filed for an immediate stay of the order at FERC. They escalated the issue to the U.S. Court of Appeals for the D.C. Circuit, and they formally requested a rehearing. But the most aggressive, mathematically fascinating counterpunch they threw was submitting a formal Section 205 filing on April 30th.
Yes, the 205 filing.
Wait, so a Section 205 filing, is that basically Eversource weaponizing FERC's own mathematical formula against them, just plugging in current 2026 market data instead of the stale 2014 data?
That is the exact mechanism. Under Section 205 of the Federal Power Act, a utility can propose a new rate if they can prove it is just and reasonable.
Okay.
So Eversource took the specific complex financial models that FERC used in the March 19th order. Those models blend discounted cash flow analysis with the capital asset pricing model.
Standard valuation models.
Right. And Eversource simply updated the inputs. They inputted today's actual treasury yields, today's actual cost of debt, and today's actual inflation metrics.
And what happened to the math?
When you run FERC's own proprietary formula using accurate current data, the mathematically justified base return on equity doesn't drop to 9.57%. It skyrockets to 11.39%.
Wow. That is a brilliant legal maneuver. FERC attempts to slash them to 9.57%, and Eversource uses the agency's own math to demand an increase to 11.39%.
It's beautiful, honestly.
They even included a secondary request to elevate the absolute ROE cap on total transmission investments, which includes performance incentives, all the way up to 12.89%.
Pushing for the absolute ceiling.
They anticipate this new elevated rate will go into effect toward the end of this year, though it will be implemented subject to refund, meaning they can start collecting the higher rate, but if a judge eventually rules against them, they would have to refund the difference.
Right.
But the strategy here isn't necessarily to win the full 11.39% in court, is it? It's to create massive leverage to force a negotiated settlement.
Exactly. During the Q&A portion of the earnings call, analysts zeroed in on the timeline for that settlement. Carly Davenport from Goldman Sachs specifically asked CFO John Morera how the Section 205 process will unfold.
And what did he say?
Morera outlined a very rigid statutory timeline. Within 60 days of the April 30th filing, FERC is expected to appoint a settlement judge.
Okay, so that starts the clock.
Right. That appointment forces all the opposing parties, which includes consumer advocacy groups and the attorneys general from all 6 New England states, into a room to negotiate.
A very crowded, angry room.
Very much so. If a compromise cannot be reached, FERC has 60 days to formally respond to the filing, and they retain the authority to suspend the implementation of the new rate for a maximum of 5 months.
So the timeline dictates that within roughly 7 months from the filing, all the procedural delays are exhausted, and Eversource expects a new, mathematically justified rate to go live.
That's the plan.
But until that 7-month clock runs out, management has to operate the business and forecast their earnings based on the punitive 9.57% reality that FERC dictated in March.
Because that's the law of the land right now.
Right. And this unavoidable dynamic forced them to officially lower their 2026 non-GAAP EPS guidance. The new reduced range provided to investors is $4.57 to $4.72 per share.
Recalibrating that guidance range downward reflects a direct reduction in future expected earnings of approximately $70 million in the aggregate for 2026 alone.
$70 million wiped out just from regulatory lag.
Yeah, the FERC ROE cut is the primary culprit. But Moreira was careful to note that the $70 million reduction also accounts for the delayed realization of proceeds from the impending sale of their water subsidiary, Aquarian.
Oh, right, the Aquarian water business sale. That is a fascinating subplot to all of this.
It really is.
Because Eversource has been strategically trying to divest this asset to completely de-risk their broader portfolio. They want to transition entirely away from water to focus purely on their core competencies in electric transmission and natural gas distribution.
Which makes sense. Focus on what you do best.
Exactly. And they secured the necessary approval from Connecticut's regulatory body, the Public Utilities Regulatory Authority, or PURA, back in March. PURA subsequently denied appeals from opposing consumer groups just last week. So what is the actual mechanical holdup preventing Eversource from closing the deal and cashing the check?
The holdup is just a strict statutory waiting period. Under Connecticut administrative law, even after PURA denies an appeal, there is a mandatory final window during which opposing parties can escalate the appeal to the state superior court.
So they have to wait out the clock again.
Yeah. That specific legal window does not close until mid-June. June 14th, to be exact. Eversource's legal counsel cannot finalize the transaction, transfer the assets, or intake the sale proceeds until that deadline expires without a court injunction.
What happens if an injunction is filed, or the deal completely unravels after June 14th? I mean, if they've already baked the sale proceeds into their long-term capital assumptions, are they suddenly facing a massive funding shortfall?
Well, the contingency planning here is very robust. CEO Joe Nolan explicitly stated on the call that they no longer have a gun to their head regarding the Aquarian sale.
What does that mean practically?
It means if the transaction is delayed indefinitely or collapses, they simply pivot to operating the asset under a revised regulatory framework. They already have a pending rate case for Aquarian fully prepared.
Just sitting in a drawer ready to go.
Yep. Seeking an $88 million distribution rate increase to adequately fund the water infrastructure upgrades.
Wow.
Furthermore, Moreira confirmed they have alternative debt financing mechanisms ready to deploy immediately to replace the expected sale proceeds. This ensures their broader grid investment plans remain fully funded. They have a primary strategy, a fully baked Plan B, and a functional Plan C.
Okay, so synthesizing this, we have a utility that just absorbed a $70 million aggregate hit to its 2026 guidance due to a federal ROE cut and a delayed water asset sale.
Right.
Yet, despite lowering the near-term bar, management looked analysts in the eye on this call and definitively reaffirmed their long-term earnings growth target of 5% to 7% through the year 2028.
They didn't budge on the long-term outlook.
How can the mathematical foundation support a reaffirmed 5% to 7% growth rate when the starting baseline just took a 100 basis point haircut?
It is a classic recalibration of the baseline. They are still committing to 5% to 7% annualized growth, but they are transparently calculating that growth percentage off the midpoint of the new lowered 2026 guidance range of $4.57 to $4.72.
Oh, I see.
Yeah, the track has been moved backward, but the velocity of the runner remains unchanged. The confidence in maintaining that velocity comes directly from the structural strength of their capital stack and their proven ability to access institutional debt on highly favorable terms.
The clearest evidence of that institutional demand was their junior subordinated notes, or JSN, offering completed in February.
That was a massive success.
For the listener, a junior subordinated note is a very unique financial instrument. It is technically a form of debt, meaning the company pays interest on it, but it sits so low on the priority ladder in the event of a bankruptcy that credit rating agencies treat a portion of it as if it were equity.
Which is a brilliant workaround.
Right. It allows the utility to raise capital without issuing new shares of stock while simultaneously protecting their credit rating. So Eversource went to the market looking to raise capital through these JSNs, and they secured $1.5 billion.
Well, $1.5 billion secured is impressive, sure. But the critical metric is that the offering was more than 5 times oversubscribed.
5 times?
Yes. For every single dollar of subordinated debt Eversource offered to the market, institutional investors pledged $5 trying to buy it.
Wow.
The market demand for Eversource's debt profile is ravenous. Those specific notes are currently trading at or above par value on the secondary market right now.
That is incredibly telling.
It proves definitively that large-scale institutional capital believes the core solvency and strategic direction of the utility are pristine. They view the FERC drama as temporary noise rather than a structural flaw.
And that institutional appetite for Eversource debt is the ultimate protective shield for the retail investor listening to this deep dive, because it directly addresses the nightmare scenario of equity dilution.
Exactly. Dilution is the enemy of the retail investor.
Right. When a capital-intensive company needs billions of dollars to build infrastructure, they have 2 primary levers. They can issue debt, or they can issue new shares of stock. If they issue new shares, the total number of slices in the pie increases, meaning your existing slice immediately becomes less valuable. Your ownership stake and your claim on future earnings is diluted.
And avoiding that dilution is the paramount goal of utility financial management. Because their debt offerings are heavily oversubscribed, and because they have $2 billion in state-authorized securitization cash flowing onto the balance sheet over the next 18 months, Eversource's reliance on the equity markets is vanishingly small.
How small are we talking?
Well, Morera modeled this out explicitly for the analysts. Over their massive 5-year forecast period, they anticipate needing a maximum of only $800 million to $1.1 billion in new equity issuance.
To contextualize how incredibly small that equity requirement is, you have to look at the sheer scale of their infrastructure ambitions. Eversource is executing a breathtaking $26.5 billion 5-year capital plan.
$26.5 billion.
Yes. They're deploying $26.5 billion into grid modernization, integrating renewable energy sources, and hardening physical infrastructure against extreme weather through the year 2030. To fund a $26 billion build-out while only needing to tap the equity markets for $1.1 billion is an extraordinary feat of capital engineering.
It really is. It ensures that the massive future earnings generated by that $26.5 billion rate base expansion will flow directly down to the existing shares, rather than being watered down across a flood of newly issued stock.
That is exactly what you want to see as an investor.
And their cash flow metrics are built to absorb this expansion safely. Standard & Poor's calculates their FFO to debt ratio at 14.2%, and Moody's models it at 14.5%.
Both very healthy numbers.
Right. Both of those figures sit comfortably over 100 basis points above the strict thresholds that would trigger a credit downgrade. Notably, S&P formally reaffirmed Eversource's stable credit outlook on April 10th.
Which was weeks after the negative FERC ROE decision was handed down.
Exactly. The credit agencies ran the stress test on the federal smackdown and concluded the underlying cash generation of the utility remains completely unthreatened.
The rating agencies see the fortress balance sheet underneath the regulatory shrapnel.
Well put.
So we have systematically unpacked the headline earnings differential, the operational paradox of the blizzard response versus the securitization rescue, the historical absurdity of the FERC transmission battle, and the mathematical mechanics protecting the stock from dilution. I need a definitive, actionable verdict for the listener analyzing their portfolio today. Okay, let's do it. Navigating the crosscurrents of this Q1 call, is Eversource presenting a bullish opportunity or a bearish warning for the retail investor?
The verdict is conditionally bullish, heavily weighted toward the patient, long-term investor.
Conditionally bullish. Break that down.
If your strategy involves swing trading for rapid capital appreciation over the next 3 months, this asset will absolutely frustrate you. The headline risk generated by the FERC ROE dispute is tangible, and it will guarantee persistent volatility in the stock price as the Section 205 settlement process grinds through the federal bureaucracy over the next 6 to 9 months.
So expect a bumpy ride in the short term.
Yes. However, if you look beneath the temporary regulatory noise, the fundamental cash-generating mechanics of the infrastructure are incredibly sound and accelerating.
Because the pillars of that bullish thesis are entirely structural. First, you have unparalleled near-term liquidity. The impending influx of $2 billion from the Connecticut and New Hampshire storm securitization dockets essentially bulletproofs the balance sheet against short-term shocks.
That's pillar one.
Second, you have the mathematical certainty of minimal equity dilution, funding a $26.5 billion capital runway while capping new equity at roughly $1 billion guarantees that rate-based growth translates cleanly to per-share value.
And third, we have the imminent completion of massive physical clean energy infrastructure that fundamentally shifts their generation profile.
Oh, right, the offshore wind stuff.
Yeah, the physical infrastructure transition is a massive catalyst here. Management dedicated significant time to the Revolution Wind project. This is a massive offshore wind development being constructed in partnership with Ørsted.
Ørsted is a major player in that space.
Huge. It is a 704 megawatt facility that is currently 95% complete, and it is scheduled to hit full commercial operation in the second half of this year. Integrating a 704 megawatt offshore wind asset alongside their other investments like Vineyard Wind and the Clean Energy Connect Hydro Corridor alters the energy supply dynamics of the entire New England region.
And the operational efficiency of offshore wind in the Northeast is fascinating. CEO Joe Nolan emphasized that these specific offshore turbines operate at a 50% capacity factor.
Which is just incredible.
In the world of renewable energy, sustaining a 50% capacity factor is elite performance. But more importantly, offshore wind generation naturally peaks during the brutal winter months, exactly when heating demand spikes and the New England grid is under the most severe operational stress.
It provides peak power exactly when the wholesale market is desperate for it.
So translating all of this into an actionable strategy for you, the listener. If you currently hold an ES position in your portfolio, the data suggests you should hold through the turbulence.
Absolutely.
Do not let the financial media's hyperfixation on a 100 basis point federal ROE cut push you into a panic sell. The protective moat provided by the $2 billion in state securitization cash and the ironclad stability of the balance sheet vastly outweigh the temporary damage of the FERC penalty.
Plus, you're collecting a highly secure, reliable dividend yield while you wait for the legal process to run its course.
But what about for the investor sitting on the sidelines analyzing Eversource as a potential new acquisition?
If you are evaluating an entry point right now, your entire focus should be monitoring the Section 205 settlement docket over the next 7 months. The market has currently priced the stock, assuming the punitive 9.57% ROE is permanent.
Right. The worst case scenario is already baked into the price.
Exactly. If Eversource's legal team successfully navigates the settlement conference and secures a revised transmission ROE anywhere near their mathematically justified 11.39%, or even if they just compromise and reclaim a rate above 10.5%, the institutional market will trigger a rapid, significant re-rating of the stock.
The stock will pop.
Yes. The uncertainty discount will evaporate, the newly elevated rate will lock into the long-term models, and the valuation will expand. Historically, the optimal window to acquire utility assets is precisely when the regulatory environment appears the most convoluted and hostile to the casual observer.
Because that complexity creates the pricing discount.
Spot on.
So to synthesize the vast ground we have covered today, we examined a utility capable of absorbing the physical devastation of a 40-inch blizzard, restoring power to 500,000 customers, and leveraging state legislative mechanics to securitize the costs, instantly unlocking $2 billion in restorative cash.
A huge operational win.
We decoded the mathematical warfare of a 15-year legal battle where Eversource is weaponizing FERC's own Section 205 framework to demand an 11.39% return on their transmission infrastructure.
Brilliant legal strategy.
And we verified that despite a temporary reduction in 2026 guidance, their $26.5 billion grid modernization plan is structurally funded in a way that aggressively protects the retail investor from equity dilution.
It really serves as a masterclass in modern utility administration. I mean, management is simultaneously prosecuting an aggressive legal war against federal regulators in Washington while maintaining highly collaborative, lucrative legislative partnerships with state governments locally to secure the liquidity necessary to harden the physical grid.
It's an incredible balancing act. But, this deep dive wouldn't be complete without examining one final, wildly contrarian detail buried deep in the Q&A segment of this earnings call.
Oh, this is the best part.
It is a strategic stance taken by Eversource management that actively defies the most dominant, hyped narrative currently driving Wall Street valuations.
The divergence regarding artificial intelligence data centers.
Yes. If you listen to the earnings call of almost any other major utility company in the country right now, management teams are practically pleading with big tech to build AI data centers within their service territories.
Begging them.
The server farms required by Microsoft, Google, and Amazon to train massive language models consume an astronomical amount of continuous electricity. Wall Street analysts have essentially transformed utility stocks into backdoor AI plays, operating on the thesis that utilities will sell unprecedented volumes of power to these data centers, creating a generational surge in revenue growth.
The consensus is that AI data centers are the ultimate utility cash cow right now.
Yet, when questioned about energy supply and demand forecasting by analysts, Eversource CEO Joe Nolan delivered a stunningly blunt rejection of that premise. He explicitly stated, "We are resisting data centers. I'm really not interested in a data center coming here."
Which just shocked the analysts on the call.
He expanded on that rejection by saying, "It's of no value to our residential customers, actually any customer. It's only going to drive up the price of energy." Hearing the CEO of a publicly traded utility publicly refuse the largest potential demand growth catalyst of the decade requires us to examine the underlying mechanics of the New England energy market.
Because it seems counterintuitive at first glance.
Why would adding a massive guaranteed commercial customer be detrimental to the utility?
Well, the answer lies in how regional wholesale electricity markets actually function. New England operates on a competitive wholesale market governed by a regional transmission organization.
ISO New England.
Right. And the price of electricity at any given moment is determined by a clearing price mechanism. Generators bid their power into the market, starting with the cheapest sources like nuclear and hydro, and moving up to more expensive sources like natural gas peaking plants.
Okay, so they stack them from cheapest to most expensive.
Yes. The market accepts bids until demand is met. Crucially, the price of the very last most expensive megawatt needed to meet demand, the marginal unit, sets the clearing price that every generator gets paid.
Wait, really? Every generator gets paid the price of the most expensive plant?
Yes. So if a massive AI data center suddenly drops into Massachusetts and begins drawing a continuous massive load from the grid, it artificially spikes the total regional demand.
Which means they have to turn on the expensive plants.
Exactly. To meet that newly elevated demand, the grid operator is forced to activate those older, highly inefficient, vastly more expensive peaker plants. Because those expensive plants are now required to balance the grid, the wholesale clearing price for the entire region skyrockets.
And Eversource, as a distribution utility, does not simply absorb that wholesale cost. They pass it directly through to the customer.
Right. Precisely. So the data center gets its power, but the clearing price mechanism ensures that every single residential customer, every small business, and every hospital in the state sees a massive structural increase in their monthly electricity bill.
So the data center enriches big tech, but it punishes the local ratepayer.
By rejecting the AI data centers, Nolan is actively choosing to protect the residential ratepayer from those wholesale price spikes. He's sacrificing the short-term commercial revenue bump for long-term stability.
Which brings us to the political chess match. Eversource's entire corporate survival depends on maintaining constructive, favorable relationships with the state utility commissions and governors in Massachusetts, Connecticut, and New Hampshire.
The people who approve the rate hikes.
Exactly. These are the politicians who approve the rate cases that drive Eversource's 18-cent earnings boosts. If Eversource facilitates an AI data center that subsequently causes the heating bills of working-class voters to double, those politicians will crucify the utility in the next rate hearing.
It is an incredibly sophisticated long-term regulatory strategy disguised as consumer advocacy.
Italy.
By taking a highly public, documented stance against the tech giants and prioritizing grid affordability, Nolan is stockpiling immense political capital. He is signaling to the state regulators that Eversource is a partner in protecting the local economy, rather than a predatory monopoly chasing a tech-driven cash grab.
It's a genius move.
It is. When Eversource inevitably returns to those same regulators next year asking for permission to fund another $1 billion in grid modernization, the regulators will remember who fought to keep the clearing prices down.
So here is the final provocative concept for you to evaluate as you review your broader portfolio. Is Eversource executing a brilliant, localized strategy that will secure decades of steady, state-approved infrastructure growth by winning the absolute loyalty of their regional regulators?
Or are they being overly conservative, stubbornly leaving the single largest revenue expansion opportunity of our generation on the table, while competing utilities aggressively capitalize on the AI revolution?
Look at the other utility assets you hold. Are their management teams prioritizing their lucrative new relationships with big tech data centers, or are they prioritizing their relationship with the residential ratepayer who ultimately controls the political environment?
It's a question every utility investor needs to ask themselves right now.
The data from this quarter proves that the most critical drivers of a company's valuation aren't always the visible storms dominating the headlines. The true trajectory of the stock is dictated by the invisible structural engineering of the balance sheet and the quiet regulatory wars being waged behind closed doors. Thank you for joining us for this intensive Talk Tickers deep dive into Eversource Energy. We will see you next time.